with that theme, Ambit Capital has put out a report. It expects the economy to pretty much come to a grinding halt in the second half of this financial year. Sample this in a report released today. Ambit has pegged GDP growth for the second half of this financial year at a mere 0.5%. Joining us now is Saurabh Mukherjea of Ambit. Saurabh, appreciate you joining us here on CNBC TV 18. You know, while everyone has been talking about the disruption and the disorder that the demonetization is going to cost in the short term, I think yours is perhaps the only report that at least I've seen that talks about such a sharp fall. You're talking about going from 6.4% in H1 of FY17 to 0.5% in the second half, and you also say there is a distinct possibility of growth contracting in the third quarter of FY17. What are you basing these assumptions on?
So I think what's worth realizing is whilst RBI and the bankers are clearly working very hard, ours is a country where 85% of transactions are done using cash. And just given the sheer scale of demonetization, you've taken pretty much the entire currency out of the equation. Given the scale of demonetization in our country, it's going to be a while before cash transactions resume as normal in this quarter. So Q3 GDP degrowing is largely based on the assumption that we've already lost 4 or 5 business days, and by the time things normalize, it's highly likely that we'll lose at least 7 or 8 business days in a quarter. There's around 65 working days in the quarter. If we lose 8 out of 65 working days in a quarter, it'll be an absolute miracle if GDP grows in Q3. So that's the short-term impact. It's largely lack of cash. But as we go through into January, into the new year, what will happen is a lot of small businesses will realize that the world of surviving without paying tax is gone. And a lot of small businesses that we are talking to are saying that, look, if we have to pay a full tax rate, we simply don't have a viable business. So our reckoning is through next year, you'll see large-scale shutdowns of small businesses who don't have a viable business after they pay full tax. That is the drag on GDP going into Q4 and into the calendar year next year. Next year's GDP drag is not about lack of cash. We will have cash next year, I'm sure, in plentiful amounts. Next year is largely about small businesses who hitherto never paid tax properly, realizing that they don't have a viable business in a country where they have to pay a full tax rate.
Okay, so since you're talking about growth implications, Saurabh, you're saying that you've cut your GDP growth estimate for FY17 by about 330 basis points and for FY18 by 150 basis points.
That's right. So the further we go away from the events of 9th November, the less extreme the hit on growth. So the current quarter, as you were saying, there's a high possibility that we believe in the current quarter you'll have negative growth, i.e. the economy will shrink in the quarter to December in all likelihood. Even the quarter ending March, GDP growth will be at a crawl. But next year to March 18, things improve. We'll have healthy numbers. In the current context, 5.8% growth is not a bad outcome. But the real fruits of what the government has done come out over the longer run. Lower cost of capital. I think the bankers you're talking to are pointing to huge inflows into their bank accounts. So the cost of bank loans will fall sharply over the next 3-4 years. We estimate that in the next 4 years, the SBI base rate will fall by 360 basis points. So by FY19, FY20, you could be taking out a bank loan at 6%. That's a very exciting possibility. That will stimulate the economy, but that economic recovery is a year and a half away. First, we have to go through this once-in-a-generation adjustment as you shed the black economy and move to a more formalized economy.
You know, you're saying that we could see bank rates come down to about 6%, but that's FY19 and 20. That's the assumption that you're working with, of course, if it all pans out as we speak. But in terms of the market implications, and I'm talking about the stock market implications, Saurabh, you have now scrapped your Sensex target, which was of 29,500 for March 2017, and your March 18 target for the Sensex now is 29,000.
Yeah. So look, as you pointed out, we don't think the economy really grows at all over the next 4 or 5 months. And with the end of FY17 only 4 months away and earnings growth almost highly unlikely to materialize in those 3-4 months, we didn't think we had any logical basis for our 29,500 target for March 17. Hence the scrappage. in the full year to March 17, earnings growth will be measly in India, 2-3% at best, and hence we have no rational basis for saying that the stock market will be suddenly at 29,500 in March 17. Looking out longer.
So where do you see the Sensex in March 2018, Saurabh?
So look, the March 2018 target is given as 29,000 on the premise that next financial year, earnings in our country grow at a healthy 9-10%. So even if you assume very healthy earnings growth in the next financial year, 9-10% is probably the best earnings growth rate we've seen in India for 4 years. So if we get to a 10% earnings growth in the next fiscal, 29,000 in March 18 is our most likely estimate for the Sensex. That's 10% upside from where we are. At one level, I think 10% upside, given how difficult things will be on the ground, will actually be quite a good outcome. The reason I'm not that downbeat about the market is 3 reasons. I think most investors we are talking to realize that this is a good thing for India in the long run. You're bringing down the cost of land, black money in real estate will be flushed out by and large. You're bringing down the cost of capital, and alongside that, you're creating a system where the tax to GDP ratio, the taxable base in our country goes up. So investors realize this is a good thing. A lot of foreign investors I've spoken to will be looking to buy on the market pulling back. My reckoning is in the near term, next 1, 2, 3 months, there's a reasonably high possibility of a 10% pullback in the Sensex. But as I'm saying, most clients that I am talking to are likely to buy into that dip. Then a dip looks likely to come in the Sensex, given all the mayhem around us. But that dip will be bought into, and hence over a year and a half, 10% upside in the Sensex is my base case scenario.
What do you reckon they'll be buying if you do anticipate them buying into the dip, Saurabh?
Sure. So I think as I was saying, right through next year, what we reckon will happen is small businesses will throw their hands up and saying, we are out of here. We don't think we have a viable business in a country where we have to pay a full tax rate. So in sectors such as, say, building materials, all manner of consumer goods, even banking, financial services, as the informal sector exits, the formal sector's market share will gain. And formal sector's market share will increase. So whether it is in electricals, whether it's in plywood, kitchenware, footwear, clothing, across the piece, we think the formal sector will gain market share. And it's hard to exactly say when this market share switch begins. But my reckoning is by summer next year, the market-leading listed businesses, sector leaders, will start talking about this. They'll start saying by summer next year, and look, in our sector, you can see the informal guys exiting, the small players exiting. We are consolidating our market share. And that's what really the investors are looking for. They're looking for market share gains next year. I don't think anybody will be rationally looking for a growth pickup next year. It's highly unlikely to materialize a big growth pickup next year. But what we're looking next year is a transition year. As the informal sector gradually dies out and the share of the informal sector reduces, we're looking to see if market-leading listed businesses are able to then grow their market share. I think the possibility of that is high, and therefore market-leading franchises across a range of sectors from stockbroking, banking, building materials, consumer goods, that's where we are pointing our clients towards.